name is Dana Golden. Today we're going to be continuing on with the electricity lectures, and we're going to be looking at techno-economic analysis. A lot of you will probably end up, if you end up in this profession, doing this at some point in your career. And what techno-economic analysis is a comprehensive evaluation combining techno-economic factors to assess the feasibility, cost, effectiveness, and sustainability of a project or technology. So you're doing the engineering side and you're doing the economic side together. This is probably not something you can publish in economic research. It's very difficult to convince economists this is valuable, but it's very valuable. If you want to be in the industry, you have to be able to do this kind of analysis. So technical analysis evaluates system performance, efficiency, and scalability, and includes assessments of technology readiness and operational feasibility. And economic analysis estimates capital costs, operation expenses, and revenues. And it looks at NPV, levelized cost of energy, discount payback period. So it allows you to think about what sort of assumptions am I making and how the technical assumptions feed into the economic assumptions. And that's very important for any convincing of anyone to fund a technology. You can do this for renewable energy projects, any emerging technology like battery storage and hydrogen production. And you can do this for just other things. So example, technical analysis for a solar farm. Evaluate the feasibility of a 50 megawatt solar farm. You have technical factors. You have a capacity factor of 25%. You have a lifetime of 25 years. You have a degradation rate of 5% per year, or 0.5% per year, which means that you're losing a little bit of the power over time. Capacity times capacity factor times hours per year. This is the expected amount of electricity you'll have. And then that's going to go on bottom. You did that through a technical analysis. And then on top, you have the economic analysis, which you have capital costs, operating maintenance costs, discount rate, which is not something I think a lot of engineers at the lower levels think about. But the engineers I know who are like at the top levels are thinking about the interest rate and the discount rate all the time. And then you have the electricity price and the LCOE calculation. You can go discounted costs over discounted energy generation. So you have this. You put it in the discount rate as 6%. You have your discounted costs. You get out $35 per megawatt hour. So now you have an electricity price of $50 per megawatt hour. You do 50 minus 35. You multiply by the total electricity you expect, or by years. So you subtract discounted revenues from discounted costs, and you get 8 million. So this is technically viable and consistent with the energy output you expect. And so it's technically viable. It's economic and competitive with a positive NPV and an LCOE below the electricity price. So you can go forward with the project. And I can't stress enough that this is something that you'll do very often throughout industry. So you also have this metric that we talked about earlier as well, the levelized avoided cost of energy. And this measures the economic value of electricity generated by a new resource compared to the cost of electricity it displaces or avoids in the grid. So it reflects the market value of energy from the new resource, and accounts for wholesale electricity prices, avoided generation costs from displaced resources, and grid reliability and resource availability. This basically is the idea of levelized cost of energy is a supply variable. It's a cost. It's a marginal cost. And levelized avoided cost of energy is the benefits, the demand variable. So what cost you're displacing and what generation you're creating. So if LACE is greater than LCOE, you should do it. Otherwise, you should not do it. So this is about whether it's good for society. A 50 megawatt power plant generates 109,500 megawatt hours annually and avoids 4.5 million in cost per year by displacing fossil generation. So you have the avoided costs, you have the annual generation, and you have the project lifetime and discount rate. And then you calculate the present value of avoided costs. You have the avoided costs on top. You have the discount on bottom. You sum it up. You have the present value of energy generated by year, discounted. And then present value of energy. And then now LACE is present value of avoided costs over present value of energy equals 49.78. So if this is greater than the LCOE, you should do the project. So comparing LACE and LCOE, it provides a measure of economic viability for a new energy resource. LACE greater than LCOE, the resource is economically attractive as it provides a greater value than its cost. Otherwise, the resource is not competitive and shouldn't be built. Together, they provide a holistic view of how both cost and value interact, aiding investment decisions. LACE and LCOE use case policy and decisions. So this encourages the deployment of resources that provide net benefits to the grid. So if the wind farm has a $40 per megawatt hour LCOE and a $50 per megawatt hour LACE, it's economically valuable, offers value to the grid, and you should do it. One last thing I'll say about here, I don't have in the slides, but you might want to incorporate, ideally the government is doing something to do this. Ideally there's something like a renewable energy certificate or subsidies for solar energy that internalize the externality. But if you're a planner and you're looking at whether or not a resource is valuable, you should also take into account that maybe the price of carbon needs to be thought of in here, and maybe the electricity price is not fully internalizing the cost of carbon. So here's the electricity supply curve. We'll talk about more how this is actually formed, how it sets the price later on. But this is similar to the cost curves you saw in commodity markets. And so you have renewables over here at the very end with a very low cost curve, almost no marginal cost. So they're dispatched at almost any price, sometimes even negative prices. And then you have nuclear, which then also has a very low marginal cost, so it gets dispatched at a low price. And then this is for PJM, so you have coal, and then you have natural gas, and then you have oil. If electricity prices get really, really high, you'll have oil. Recently, the stack has shifted so that natural gas is closer to here than here. So it's more blue and then some black. But yeah, nuclear and renewables are always still here, and oil is almost never competitive. Actually, most of the time on this diagram, I don't know why it's not here, but normally you'd see oil, and then you'd also see like a wood burning resource. Like wood burning is like right above oil in terms of cost competitiveness. I don't know like why these things still are out there. So investments in power generation are driven by the need to meet energy demand, comply with regulatory requirements, achieve economic returns, and you evaluate this through levelized cost of energy. So how you should think about whether or not you should invest, you should think about the capital costs, you should think about the operating margin costs, you should think about how these feed into profits, then you should think about, first off, the regulatory and policy environment. Are those carbon prices going to be internalized? Are there subsidies? Is there, like what we'll talk about in Lecture 13, is there a capacity market? And what is available to encourage you to build generation, particularly renewable generation, if you are looking at it? Is there subsidies for renewables? And then, is renewables even allowed to participate in the capacity market to get those capacity payments and uplift? And then, what do you expect future energy prices and demand to be? Do you expect a lot of other generation to come online? Right now, we're seeing a lot of renewable energy generation coming online, but we're also seeing a lot of natural gas queued because load has started to rise, demand has started to go up for the first time in decades, and now, even in the middle of the need for renewable energy transition, we're building natural gas. So these are things to think about: is what is the macro landscape of your market going to look like when you're thinking about building generation. So here's the LCOE formula again, and here's how it comes into investment, how it allows you to compare generation different technologies. Some limitation. So, of course, it counts with time value money by discounting future cost of generation, but does not account for system-level impacts, intermittent grid integration costs. So, you might want to think about the fact that wind and solar are not baseload, and assumes fixed generation and cost structure over time. One thing that I think should be obvious here is that, and I think we'll talk about it next lecture in bidding in electricity markets, but The price of electricity is not an exogenous process. It's very much an endogenous process caused by the generators who are present. So by adding renewable generators, you're lowering the price of electricity, which might actually make it less cost competitive or less desirable to be a renewable generator and to enter into the market. So just think about what is your entry and what is the entry of other similar players going to do to the market. And I'll leave it there. I hope you'll join me next time for transmission. I hope you have a great day. Thank you.